let's go over the income statement. The income statement, as mentioned before, it represents a company's operating performance over a specific period of time. So typically an income statement shows an annual performance of a company. Sometimes it's annual, sometimes it can be over a quarterly period. Internally, maybe some companies have income statements that are recorded on a monthly basis as well. But usually when we analyze financial, analyze stocks and companies, usually it's over a 1 year time period. But anyways, the income statement typically looks like this. Wherever you go around the world, it's going to look like this. The balance sheet and the cash flow statement, however, on the other hand, sometimes it looks different. It differs by industry, it differs by situation, but the income statement is usually looking like this. Just one thing is that sometimes cost of goods sold and selling, general and administration expenses, COGS and SG&A, these two sometimes are these days combined, and we use the phrase OPEX, operating expenses. But in most countries still we use income statements that look like this. But anyways, let's go over just line by line about the definitions and the meanings of the accounts. First of all, the revenue is money generated from business operations. I believe most of you would understand what revenue is. So let's say we're running a cafe business. So you've sold a hot vanilla latte worth $5. That's going to be recorded as revenue. So money generated from business operations. Cost of goods sold are costs that are directly related to revenue. So usually they're costs such as coffee beans, the syrup for the latte, the cups. So material costs that are required in order to generate revenue. Also, labor costs can also be included in cost of goods sold. For example, a barista's, the person who's making the coffees, labor costs can be included in cost of goods sold because they're directly related to revenue. We have gross profit. We've wrote GP, but it stands for gross profit. Gross profit is simply revenue minus cost of goods sold. Selling, general and administration expenses are, by definition, it means operating expenses that are not cost of goods sold. So these two combined, cost of goods sold and SG&A, these two combined are called operating expenses. So whichever expenses that are related to your daily operations, whether it's material costs, whether it's labor costs, marketing, rent, administration, legal fees, just anything that's related to your operations should be included in either COGS or SG&A. But the sole difference is that is it related to your revenue generation? If it's related, go to COGS. If it's not related, go to SG&A. And if you subtract COGS and SG&A from your total revenue, you'll reach operating profits. So operating profits would mean profits from the company's core operations. So anything below operating profits is going to record anything that's unrelated to your core operations. So for example, if you're doing a cafe business, but you've earned money through rent, for example, if the cafe owns a building and you've made profit, utilizing that building, you've rented to others, and you've recorded profit from the building, that kind of profit should not be included over the operating profit, but rather under the operating profit on typically on other income and other expenses. It's also called non-operating income, non-operating expenses, but it should be written down here. One thing I forgot to mention is that operating profits are also often called and used as a similar term to EBIT, earnings before interest and tax. So these two terms are often interchangeably used. If you go to an advanced course, we're going to, there's a slight difference between operating profit and operating EBIT. But for now, let's just keep it that way. Let's just say that these two are similar concepts and very similar terms. And under operating profits now, we have other income and other expenses. And as we've told, expenses and income that are not related to operations. Typically, investment incomes, investment expenses, interest incomes, interest expenses, and rental incomes, and so on. So if your company is invested in Bitcoins for whatever reasons, and they made profit, or if they made a huge loss, they're going to be recorded under other income, other expenses. Oh, and I forgot that we made a separate column for interest expense. So interest income and interest expense are also separately recorded. And if you add and subtract other income and interest income, we reach earnings before tax. So it's the final result of all revenues and expenses, but just excluding income tax. And lastly, we pay corporate tax. And the final result, the ultimate result, would be net income. So, if you sell, coffee, there's a long way to go until you finally reach your, true profit as a shareholder. The income statement possesses some hidden meanings. It shows each stakeholder's priority over the revenue generated. So if we start from the operating profit, the first priority is to pay raw materials and pay labor costs, marketing costs, all costs related to operations. So that's the first priority from your revenue generation. And then the next priority is the creditors. So we first pay interest if we have enough left over from operating. If we don't generate enough money from operating activities, we won't have enough left over for the creditors. But anyways, the first priority after the operating expenses are the creditors, which are typically, interest expenses are typically for banks and bond investors and so on. The next priority would be the government. So the government as well, if there's nothing left over until earnings before tax, if the company has paid off a huge interest and there's nothing left to take as corporate tax, the government cannot declare tax for the company. So the government as well can only take the tax when there's something left over from all these activities. And the last priority would be the shareholders. So the shareholders take whatever's left. So if there's a lot that's been left over, the shareholders are going to take a lot. If there's nothing that's left over, the shareholders are going to end up with nothing. So it shows the riskiness of each tranche's investment, and also it's also related to the each tranche, the returns, the required rate of returns of each investment. So that's much about the income statement, and let's proceed to our balance sheet.